Thailand isn't just one of the largest economies in Southeast Asia. It's a powerhouse that defies expectations, both in its economic achievements and the relentless political turbulence it has endured. Nestled strategically along the world's busiest trade routes, Thailand doesn't just sit back and enjoy the view. It plays a critical role in global commerce, quietly supporting some of the world's most essential yet underappreciated goods. What makes Thailand even more remarkable is that despite the odds stacked against it, political instability, regional crises, and global downturns, it continues to grow. For many, this wouldn't be surprising. After all, a country with abundant natural resources, a large labor force, and a prime geographic location might seem like a recipe for success. But the truth is, there are countless other nations with similar advantages that still struggle to get ahead. So why does Thailand continue to defy the odds? The answer lies in the nation's unwavering resilience. Over the past century, Thailand has been no stranger to political upheaval, with 2 military coups every decade on average. The country has been toppled by its own leaders more times than it has been peacefully re-elected. In a world where political stability is often a prerequisite for economic success, Thailand's ability to grow amidst such chaos is nothing short of astonishing. Yet, even in the face of these challenges, Thailand has weathered numerous global economic storms. The Asian financial crisis in the late 90s, the global financial crisis, GFC, of 2008, and even the COVID-19 pandemic each hit the country hard, but the economy still managed to pull through. The question remains, what has made Thailand's economy so resilient? And what's driving its most recent growth? To understand Thailand's economic success, we first need to look back at its history, especially the moments that shaped the nation's trajectory. Unlike many of its Southeast Asian neighbors, Thailand never fell under direct colonial rule. This distinction was crucial, allowing the country to carve out its own path while the rest of the region was divided among European powers. In fact, Thailand acted as a buffer zone between the British and French empires, maintaining its sovereignty while also benefiting from being at the crossroads of trade between them. Thailand's geographic position played a huge role in its early economic prosperity. After the opening of the Suez Canal in 1869, Thailand became a critical exporter of rice in the region. This trade boom positioned the country as a key player in global markets. But, much like many nations, its wealth was often concentrated in the hands of a few elite technocrats. While the economy grew, the benefits were not always felt by the broader population. This disconnect between economic growth and widespread prosperity would continue to be a theme throughout Thailand's development, but it all began to change in the 1980s, a decade that would lay the foundation for the modern economy we see today. The Plaza Accord, signed in 1985, was a turning point. Though Thailand was not directly involved in the agreement, which aimed to devalue the US dollar against currencies like the Japanese yen, the consequences were felt worldwide. For Thailand, the most immediate effect was the devaluation of its own currency. In 1984, the Thai baht was pegged to the US dollar at 25 baht per dollar, and when the US dollar weakened against other major currencies, Thailand's currency lost value as well. In particular, the appreciation of the Japanese yen had a dramatic impact on the Thai economy. Japanese products became more expensive, which drove Japanese companies to look for ways to cut costs. With China still in the early stages of opening up, Thailand became an attractive alternative for Japanese manufacturers. This set the stage for a wave of Japanese investment in Thailand during the late 1980s and early 1990s. As Japanese companies began moving their operations to Thailand, the country saw an explosion of industrial development. What had once been a largely agrarian society now began to shift toward a more industrialized model. Factories replaced rice paddies, and Thailand's workforce, once dominated by farmers, now found themselves working in production plants. This industrial leap couldn't have come at a better time. With Thailand's strategic position along the South China Sea and the Malacca Strait, a key shipping channel between the Indian and Pacific Oceans, Thailand was poised to become a manufacturing hub. The government had already begun to deregulate industries and open its doors to foreign investment, making it an ideal destination for international companies looking to capitalize on low labor costs and favorable trade conditions. As Japan outsourced its manufacturing, Thailand quickly transformed from an agricultural economy into one focused on exporting goods. No longer was Thailand simply an exporter of rice and raw materials. It had become a competitive player in the global market for manufactured goods. The country's industrialization accelerated, and it became clear that the country was positioning itself as a central player in global trade. The shift was not without its challenges, of course. Despite this newfound industrial prowess, the benefits of this growth were often still felt by a limited segment of the population. The broader population was still grappling with the social and economic disparities that have plagued Thailand for decades. But the country was undeniably on the rise. As factories sprang up and Thailand's exports surged, the country's economy was reshaped in ways that would make it one of the most important players in Southeast Asia. As Thailand's economy boomed, particularly during the 1990s, the country's industrialization began to show serious signs of strain. What started as a period of immense growth began to teeter, setting the stage for a catastrophic economic crisis. The sudden shift from prosperity to peril can be traced back to the way foreign investment flooded into the country, inflating an economic bubble that was bound to burst. The currency peg to the US dollar provided a sense of stability that lured international investors. Loans were easy to obtain, with relatively high interest rates being charged, which encouraged both foreign banks and local institutions to take on more debt. The appeal was clear: borrow in foreign currencies, convert the funds to the Thai baht, and invest in the booming market. However, as with all bubbles, there came a tipping point. By 1990, Thailand had opened its financial system to global markets, accepting Article 8 of the International Monetary Fund, IMF, which allowed for more liberalized monetary policies. Foreign investment increased, and money poured in with little regard for long-term consequences. This led to an excess of capital in the Thai economy, which only pushed up asset prices, creating an overinflated market. But soon, the cracks began to show. The influx of money was no longer funding new, productive investments. Instead, it was driving up the cost of real estate, making speculative investments the norm. The banks, meanwhile, were lax in their lending practices, offering loans without proper risk assessments. With reckless borrowing and lending came a house of cards, unstable and teetering on the brink of collapse. But the real game-changer was China. The country had slowly been opening up its economy, and by the late 1990s, it was ready to compete on the world stage. China's ability to produce goods more cheaply and at a massive scale took away Thailand's competitive edge. The third blow came from within. Unprofitable industries, especially the real estate sector, began to buckle under the weight of high interest rates. The housing market, fueled by speculative investments, turned into a ticking time bomb. As demand waned, the bubble burst. Real estate prices collapsed and loans went into default. The banking system, which had been heavily exposed to these risky investments, was left reeling. As bad debts piled up, the financial system became increasingly unstable. This cascade of events left Thailand vulnerable. International investors, spooked by the growing instability, began pulling their capital out of the country. With everyone trying to withdraw their money at once, the Thai baht's value plummeted. But because of the currency peg, the government was forced to intervene, pumping US dollars into the market to keep the baht's value artificially high. However, this only worsened the situation. The government had to deplete its foreign reserves to maintain the peg, but the crisis was unstoppable. At this point, the situation became dire. Thailand's foreign exchange reserves were running dry, and the country's stock market crashed. The Thai baht, which had previously traded at around 26 to the dollar, had lost almost half of its value by the end of 1997, plummeting to 53 baht per dollar by January of 1998. The collapse had a severe impact on the population, with unemployment soaring from 1.5% to 4.5%. While that might seem relatively low in developed economies, in Thailand, where the unemployment rate had always been much lower, this was a devastating blow. Without a strong social safety net and with poverty already a daily reality for many, the rise in unemployment meant widespread hardship. In the aftermath of the crisis, Thailand found itself in an economic freefall. Foreign investors had fled, and the country's credit ratings were in tatters. But amidst the chaos, there was a silver lining. Thailand had made significant infrastructure investments in the years prior to the crisis. The country's roads, ports, airports, and electricity grids were modernized, and this infrastructure proved invaluable when it came time for Thailand to rebuild. In addition to this, Thailand was forced to abandon its currency peg. As the baht was allowed to float, it naturally depreciated in value, making Thai exports more attractive once again. This, in turn, helped reignite the export sector, which had been struggling due to the overvaluation of the baht during the boom years. As Thailand struggled with its economic collapse, it also turned to the International Monetary Fund, IMF, for help. The IMF provided a bailout package that allowed Thailand to stabilize its finances. After a period of paying off loans, the country was able to recover, but it was a long road. Thailand's economy didn't just bounce back overnight, but the foundations for its revival had been laid in the form of infrastructure, a competitive exchange rate, and a renewed focus on export-led growth. By the early 2000s, Thailand had begun to recover. The nation's economy, battered but not broken, started to grow again. The lessons learned from the financial crisis helped shape the future of the Thai economy. By the mid-2000s, Thailand's economy was showing signs of steady recovery. After the devastation of the 1997 Asian financial crisis, the country had restructured its financial systems and focused on rebuilding its industrial base. But it wasn't just about bouncing back. It was about transforming its economy into something more sustainable. And that transformation was marked by a crucial pivot, a shift from financial speculation to a focus on the real economy. This change was a godsend, particularly in the wake of the 2008 global financial crisis, GFC. Unlike many nations that had relied heavily on finance-driven growth, Thailand had learned from its past mistakes. By 2008, Thailand's economy was much less dependent on volatile financial markets. Instead, it had embraced exports as its primary engine for growth, making it one of the few nations in the region to weather the storm more smoothly than others. Rice, of course, was at the heart of this strategy. Thailand has been a major exporter of rice for decades, and its position as the world's leading exporter continued to be a significant economic advantage. Rice is considered an inelastic good. Its demand doesn't fluctuate dramatically with price changes. That's because, for billions of people across Asia, rice is an essential food. Given Thailand's geographic proximity to these large rice-consuming markets, the country enjoyed a steady flow of demand, even during times of economic uncertainty. In essence, rice wasn't just another commodity. It was a lifeline, providing a constant revenue stream for Thailand's economy, no matter how the winds of global trade shifted. But Thailand's success didn't hinge solely on rice exports. The country's location in Southeast Asia, strategically situated along some of the busiest trade routes in the world, helped Thailand become a key player in global trade. Whether it was for shipping goods through the Malacca Strait or serving as a regional hub for companies looking to tap into Southeast Asia's vast markets, Thailand's position gave it a distinct competitive edge. It wasn't just about being close to major markets. It was about providing an efficient, low-cost base for businesses that wanted to access those markets quickly and affordably. This geographical advantage, combined with decades of infrastructure development, allowed Thailand to become a nexus for trade and tourism. Cities like Bangkok emerged as major international hubs, not just for commerce but for tourism as well. In fact, before the pandemic, Thailand was the 8th most visited country in the world, with Bangkok being the most visited city globally. Tourism alone accounted for nearly 20% of Thailand's GDP in 2019, generating a staggering $90 billion in revenue from both domestic and international visitors. With its iconic beaches, historical temples, vibrant nightlife, and world-renowned cuisine, Thailand quickly became a go-to destination for travelers from across the globe. However, the pandemic put a temporary halt to this booming industry. Tourism revenues, which had reached record highs, plummeted in 2020 as the world shut down in response to COVID-19. From $90 billion in 2019, Thailand's tourism revenue dropped to just $24 billion in 2020. Despite this drastic decline, Thailand proved its resilience once again. Even with limited foot traffic, the country's infrastructure, strong export markets, and adaptive business practices allowed it to begin recovering swiftly, even as global tourism struggled to bounce back. Interestingly, Thailand has also become a hotspot for digital nomads, freelancers, entrepreneurs, and remote workers looking for affordable living in a country with reliable internet and a pro-business environment. This influx of digital workers added a new layer of economic activity, helping to boost local businesses and contributing to Thailand's economy in a more sustainable way. While the pace of growth may have slowed compared to the explosive rates of the 1980s and 1990s, this slower, more sustainable progress is seen by many as a positive sign. It suggests that the country is maturing, avoiding the volatility that comes with unsustainable booms and busts. However, there's always the potential for foreign influence to alter the balance. While Thailand has become very welcoming to foreign workers and businesses, offering low taxes, a relatively low cost of living, and an easy entry process for expatriates, it also limits foreign ownership of property and certain businesses. These regulations prevent outsiders from taking over the local economy while still allowing for active foreign participation. This delicate balancing act creates an environment where foreign investors and digital nomads can thrive without undermining the welfare of the Thai population. It's a system that fosters collaboration, offering tangible benefits for both locals and foreigners alike. But of course, no story of Thailand's economic resilience is complete without acknowledging one glaring issue: the country's coup culture. Thailand has a long and complicated history of military coups, with 19 of them since 1932. Most recently, in 2014, the military staged another coup, removing the democratically elected government. This would be catastrophic for most economies. In countries where coups are the norm, businesses and investors are often too nervous to operate, and the public is in a constant state of anxiety. But in Thailand, it's almost become a way of life. So much so that many industries operate with the expectation that another coup could happen at any moment. This paradox is tied to the country's relationship with its monarchy. The royal family in Thailand is sacred in the eyes of the people, and the military sees itself as the protector of the monarchy. Any coup that happens is often done with the justification of defending the monarchy, or more specifically, its interests. The royal family's special status is so ingrained in the nation's political culture that even military coups can't disrupt the fundamental structures of power. These political upheavals, while unsettling, have not been enough to cause the kind of widespread disruption that many would expect in other nations. The idea of coups in Thailand has become so normalized that they no longer destabilize the economy the way they might elsewhere. In fact, Thailand's business community has learned to operate with the understanding that a coup might change the political landscape, but it won't necessarily destroy the economy. That's because, even in the midst of political upheaval, the military and the monarchy are seen as guarantors of economic stability, and their interventions are usually not as disruptive as one might expect. But the constant back and forth of coups and political change has its costs. It keeps the country in a state of uncertainty, where long-term political stability remains elusive. The question remains: can Thailand overcome this political instability and fully unlock its potential? Will the country's unique political culture continue to serve as a stabilizing force, or will it eventually hinder the country's growth in the long term? Only time will tell.